Hello everyone, my name is Gary Moglione, and in addition to being portfolio manager on the Momentum Multi-Asset Value Trust, I have research responsibilities for what we call specialist financials. These are investment trusts that offer an attractive yield and the potential for capital growth. This is a very interesting part of the market to cover, and it includes areas such as loans, mortgages, leasing and royalties. Within royalties, a new asset class has evolved in recent years in music royalties. We first invested in the space at the IPO of Hipgnosis Songs Fund in 2018. We could see that the industry is going through massive structural changes, presenting significant opportunity for investors. The asset class offered genuine diversification from equity and fixed income, and access to some powerful themes and trends, such as technology disruption, emerging market growth, and legislative change. Our next guest is Merck Mercuriadis, who is a 30-year veteran of the music industry, with roles such as CEO of the Sanctuary Group, which at the time was the largest independent music company, and a former manager of artists such as Elton John, Guns N' Roses, Iron Maiden and the Pet Shop Boys. He is the founder and CEO of Hipgnosis, which has a current market cap of 1.5 billion. He's going to talk to you about investing in the rapidly growing asset class of music royalties. Over to you, Merck.
Hi everyone at Think Tank. I am Merck Mercuriadis. I am the founder of Hipgnosis Songs Fund Limited. It's a FTSE 250 company that I founded in 2018. And the endeavor of Hipgnosis Songs Fund Limited was to give the investment community access to the predictable, reliable income that comes from these great proven songs that we buy. Music, particularly proven music, is very predictable and reliable because when these songs hit, they become a part of the fabric of our lives and the fabric of society. So, if you were a 14-year-old girl or boy in 1982 and you had your first crush while listening to Eurythmics' Sweet Dreams Are Made of This, now almost 40 years later, that song has been a part of your life for that period of time, and it will continue to be a part of your life, the good times, the bad times. So these proven songs have very predictable, reliable income, and I compare them to golden oil because of that predictability and reliability, because those are assets that we invest in for those very reasons. But they're also better, I say, than golden oil because the income from these songs is uncorrelated to what's happening in the world. If there's political upheaval in the world, obviously the price of golden oil can be affected. If there's a pandemic, the price of golden oil can be affected. But these great songs are being listened to if people are living their very best lives. They're doing it to a soundtrack of great songs equally well, such as during the course of this pandemic. We are taking comfort and we're escaping by listening to these great songs. And you've probably seen in our performance, we joined the FTSE 250 about 3 or 4 months before the pandemic hit. And during the course of this 18 or 19 months, we've become as high as the number 23 biggest yielder on the FTSE 250, because even though we're surrounded by great blue chip companies that have been in their businesses for a long time and that generally do great business, their assets were affected by the pandemic, whereas ours, as I say, we're not, because people are consuming music all of the time, whether, as I say, they're living their best lives or whether they're looking for comfort and escape. And we have access to these great songs because I've spent almost 40 years in the music business, managing artists as great as Elton John and Guns N' Roses and Beyonce and Iron Maiden and Morrissey and Nile Rodgers and Chic. And in that period of time, I've effectively taken responsibility for those artists' careers, and I've made sure that their art and their songs were compromised in the least way possible, and that their commerce was maximized. And I've been privileged to work with these artists and to have a great career. And that's given me a seat at the table with the artistic community, the songwriting community, the artist community, the producer community, and I have access. And I've demonstrated that access by investing almost $2.5 billion in the space since we started and since we IPO'd in 2018. And we own catalogs that go from Neil Young to Lindsey Buckingham and Christine McVie's share of Fleetwood Mac, to Bernard Edwards from Nile Rodgers and Chic. We just have, incredible songs that are not only extraordinarily successful, but equally well of great cultural importance. Those are the two criteria for me. One, the songs have to have been extraordinarily successful in their lifetime. And two, they need to be of great cultural importance. And the reason for those two factors is that they give endurance. And one of the things that allows us to establish songs, that has allowed us to establish songs as an asset class, is that this rule, this is as an asset, copyright is protected by rule of law, which in general around the world is 70 years after the death of the last co-composer. So this is a very, very long income stream. We, on average, in the $2.5 billion that we've invested to date, have paid just over a 15 times multiple. But the average earning length of our catalogs is 101 years, which obviously is terrific, but it's only something that's worth talking about if you've bought songs that are going to be able to stand the test of time that way. And I'm quite certain, as I say, when you're looking at the likes of the Eurythmics, when you're looking at the likes of Neil Young or Journey with Don't Stop Believing, which is, the most streamed song of the 20th century, post-streaming, Sweet Dreams Are Made of This by Eurythmics is the most streamed song ever that was released in 1983. The same thing with Bon Jovi's Living on a Prayer for 1986. All of these great songs are songs that are part of our catalog. And our catalog is a very small catalog of only 60,000 odd songs at $2.5 billion invested, both an incredibly high ratio of success within it. Almost 5,000 of our songs were #1 songs around the world. Nearing 20,000 of them were top 10 songs all over the world. About 30,000 of them are top 40 songs around the world. So it's a very, very small catalog that's easy to manage and put bandwidth into in order to add value. When I created this company, I wanted to achieve three things. One was that I wanted to establish songs as an asset class. And obviously, with our performance, we're well on our way to doing that. We've given our shareholders a 40% total return since inception. The second endeavor was to use the leverage and the success of our fund and our songs to then change where the songwriter sits in the economic equation. And I'll tell you a little bit more about that in a few minutes. But then the third part of our endeavor was to take what is this broken publishing model and to create a new paradigm that we call song management. The big publishing companies that have been there in the decades prior to us being here have as many as 20,000 songs per person. They don't have the ability to manage songs. They're just taking incoming requests, passive requests, some of which are appropriate and some of which are completely not appropriate for the songs in question and not in the best interest of the value of those songs in question. We operate on a completely different paradigm. In song management, we have approximately 500 songs per person. And as we add songs to our catalog, we add song managers to our catalog. And they have the bandwidth to take these songs and put them in movies and TV commercials and video games and ensure that new songwriters are interpolating them and that new artists are covering them so that we can add very, very significant value to our catalog and the assets that we own. As a comparison, Warner Chappell, which is one of the big three companies, in the last fiscal year, we did approximately 19% of Warner Chappell's revenue. They did it on 1.5 million songs. We did it on something less than 60,000 songs at that point in time. We effectively did 19% of their revenue on less than 2% of the assets. And that's not because we're smarter or better than Warner Chappell. It's because we've got the bandwidth to apply ourselves and to manage these songs with responsibility in order to be able to deliver added value for our shareholders. Now, the context for all of this, in terms of why we're really doing this, is that streaming has completely transformed the way that people are consuming music. When we started the company, there were barely 30 million subscribers to music streaming services around the world. Today, we have 487 million paid subscribers to music streaming services. And by the time we get to the end of this decade, depending on whose research you're looking at, we will have as many as 2 billion paid subscribers around the world. There's a couple very important points within that. One, streaming has taken music because of its convenience, where you can listen to everything that you want, from the Beatles to Beethoven, from Chic to Chopin, in one place. You have access to everything. You can listen wherever it is that you are, whether it's in your home or your office or in your car or at the beach. It doesn't take up bandwidth on your telephone. And the consumer has decided that the convenience of this delivery mechanism makes it worth paying money for. And, we've gone from the paradigm for extraordinary success, or the benchmark, I should say, for extraordinary success in our business being the platinum record, which was, if we use the United States as a microcosm, 1 million copies in a country that has 360 million people in it. That immediately, in the old paradigm, 1 million people, 1 in 360 people, immediately tells you that while the average person may have loved music, or at least professed to love music, they didn't love it enough to put their hand in their pocket and pull out a tenner to pay for it. Now with streaming, that has been replaced by 100 million homes in the United States that have a paid music, a premium music subscription. So we've gone from our customer being that 1 in 360 to now the customer being 1 in 3.6. And this has taken music from being a discretionary or luxury purchase to now very much being a utility purchase. And this is having a massive effect on the discount rate that's used to value our catalogs. Some of you will know that the discount rate that we use internally to value our catalogs is 9% and has been since we started. But now our independent valuer is using 8.5% as the discount rate, and that is growing the value of our catalogs. And we expect this discount rate to continue to narrow, because effectively, these earnings now are very certain. As I say, you've got 100 million homes in the United States that are paying for a premium paid music subscription service as if it was a utility. And this is happening all over the world. The other key factor with streaming is that it's bringing the emerging markets with huge population centers that were previously illicit markets to the table. So when you look at India, when you look at Africa, when you look at China, markets that previously, you'd go to, culturally, you would go to the local bodega and buy the bootleg CD, or before that, the bootleg cassette for a couple of pounds. None of that money would ever make its way back to the songwriters. None of that money would ever make its way to the rights owners. Now those people are buying streaming subscription services instead with those couple of pounds, and we're starting to see money coming in from places like China and Africa and India. They're not a part of the data on which we buy these catalogs. So, if we look at India as one of the emerging markets, 18 months ago, the consumption of international music in India was 8%. They may have heard of our great Western artists and great songs, but they didn't have access. Now, with the advent of streaming, 18 months later, the consumption of international repertoire is 42%. And this is, again, is something very similar is happening in China. China has currently gone from not being even on the map of the top record markets in the world, despite having the biggest population in the world, 5 years ago or so, to now being the number 10 biggest record market in the world. And I think we're probably 1 or 2 years away from it becoming the number 1 record market in the world. And our song management also allows us to be able to take our great songs to markets like China and Africa and India, and having the songwriters there interpolate them into songs for their domestic markets, as well as to allow the consumption of the international repertoire as well. And again, it's important to point out that none of this income that's coming from these markets is a part of the data on which we buy these catalogs. The same thing for that passive consumer that is now driving consumption in the United States, as from a discretionary purchase to a utility purchase. That person's not a part of the data on which we buy these catalogs as well. And we now have, as I say, 100 million homes there that are paying $120 a year, or upwards of $120 a year for consumption of music, that were previously not paying anything for the consumption of music. They were happy to hear it for free on the radio or to see it for free on television. So these are big value adds. And of course, that subscription number is growing. As I say, we're at 487 million paid subscribers around the world today, from the 30 million that we were when we started just over 3 years ago. And we're expecting that we'll have as many as 2 billion paid subscribers by the end of the decade. There's also opportunities to add value via the collections of these sums. When we buy these catalogs, we buy them net of the administration fee. And most of these catalogs at the time of the purchase are being administered by Universal, Warner, and Sony. We only buy direct from the songwriter or the producer or the artist, but the administration rights, the collection rights, generally sit with one of those 3 companies. And those 3 companies charge anything from 15% to 40% to collect that money. And we buy net of that fee. So whatever savings we can bring to that fee is money that drops to the bottom line and adds value. So when at the earliest opportunity, as soon as that current administration deal ends, and sometimes it's the day that we make the acquisition, and sometimes it's a couple of years down the line, we move the catalog to our preferred administrator. And we have a rate with our preferred administrator that is approximately 6.5%. So there's a massive value add that comes there. You're looking at anything from a 33.5% value add to something that is 7.5%, 8.5% at the low end of things. And we also have the ability to collect the money faster and have it paid through to us faster as well. So there's a big opportunity when it comes to bringing efficiencies to the collections of these songs. And as we go forward, and as blockchain becomes a part of our world, we believe that there'll be an even greater savings in the collections of the money. And these billions of microtransactions that come through on proven songs on a yearly basis will start to get paid in real time on a sort of credit card style basis, where same way that American money flies around the world with an American Express or Visa transaction. We expect to, in the next 5 years or so, start to see the collections of our songs be paid in real time, because obviously in the streaming paradigm, everything is digital, everything is data driven, and everything is being seen in real time. And we believe the payments will come through that way as well, and there'll be another big value add. The final component of our thesis is that we are difference makers. We have a competitive advantage to other people that are out there buying songs. Part of that is my pedigree as an artist manager and the reputation that I have in the creative community. I understand that these are very emotional transactions for these songwriters. These are if you like, the metaphorical children of these songwriters. And they want to ensure that those children are going to end up in the best hands possible. They know that I care. They know that I'm going to make decisions going forward based on how, the ethos that they've built their careers on. They know that I know their careers and that I've studied them and have that knowledge. And they also know that ultimately, while I'm going to be reaching for the upside, I'm not going to do it at the risk of devaluing the songs. I'm always going to protect the value in the songs, and I'm always going to amplify their legacies. That, along with the fact that our ulterior motive is to change where the songwriter sits in the economic equation through the success of our fund, has made us the preferred buyer of the songwriting community. The songwriter, despite the fact that they are delivering the most important component in the success of an artist or in the success of a record company, if you are buying the record or streaming the record, you're doing it because you love the songs. If you go and see an artist play live, you're doing it because you love their songs. If you're buying their t-shirt, you're doing it because you love their songs. If you're buying the product that artist endorses, it's because you love their songs. The song is the source of music, and it's the currency on which not only the hypnosis business, but the entire music industry revolves. It all starts with the song. Yet the songwriter is the low man or woman in the economic equation. And that's because Universal, Warner, and Sony, as the three biggest song companies in the world, don't advocate for songwriters because they're owned and controlled by Universal, Warner, and Sony, the three biggest recorded music companies in the world. On the recorded music side of the business, they're getting an 80% gross margin, 4/5 of the revenue is going that way, a 40% net margin. And in general, they own those assets in perpetuity. Very few artists actually own their own recorded music rights. Conversely, on the song side of the business, you have 1/5 of the revenue, you've got 1/5 of the margin, and quite rightly, whether it's through good management and lawyering in the first place, or through reversions or renegotiations, the songs end up back in the hands of the people that co-created them, who we buy from directly. But Universal, Warner, and Sony, they use their leverage of their recorded music companies owning their publishing companies to push as much of the money in our business towards recorded music at the expense of the songwriter, because of course that's where they get the lion's share of the money, is in the recorded music side of the business. We think that this is wrong, and we've been advocates against this from the very beginning of the company. In fact, it's why I set the company up, was to have the leverage to be able to fight this battle on behalf of the songwriting community. And we're making incredible progress. Some of you will be aware, you will have read about the DCMS, the Department of Culture, Music and Sciences in Parliament, that have recently issued a report that I gave written evidence to. Niall Rogers, who's on our advisory board, gave in-person evidence to, and we made certain recommendations to the DCMS that they now in turn have taken almost every one of our recommendations and recommended them to the government. And chief amongst those is to recommend that the Competitions and Marketing Authority step in and investigate what we call this unhealthy relationship that exists between the major recorded music companies and the major publishing companies. This is going to create a real windfall in the amount of money that we receive for our songs. That's in the UK. It's a decision that is ongoing. The government is reviewing this very strong report right now as we speak. There's a day in Parliament on December the 3rd, a private member's bill brought by Kevin Brennan, the MP, and Julian Knight, to review this. And we believe that the UK government will make very strong recommendations on behalf of songwriters and artists in order to get more income coming their way. This is obviously a serendipitous situation, because what's in the best interest of the songwriter is also in the best interest of our shareholders. If the songwriter is being paid more money, we're being paid more for the songs that we own, and our shareholders are benefiting from that. Equally well, we've had an impact on what is known as the Copyright Board hearings in the United States. We predicted when we came to market 3 years ago that eventually the Copyright Board would recommend that the songwriter be paid more money. And in early 2019, the Copyright Board recommended and passed into law that the songwriter incrementally receive a 44% increase in their share. So $1 worth of income that we've bought previously in the United States, by the time we get to the end of 2022, will be worth $1.44. Now, some of the DSPs have stepped in and appealed that ruling, and that appeal is ongoing, but Copyright Board 4, which is the next hearing that will determine what we hope will be a further increase for songwriters, has started already. And the common wisdom now is that while that may not add more to that 44% increase, it will uphold that 44% increase. So as I say, $1 worth of income that we've bought previously will now be worth $1.44 going forwards. And this advocacy on behalf of the songwriters and on behalf of the artists has made us, as I said previously, the preferred buyer of the songwriting community. And we have, I mentioned a very envious multiple that we've paid. When you look at our competitors, our multiple of just over 15 at $2.5 billion invested. Nobody has done that in our business. Most of the other companies out there are paying far higher fees or far higher purchase prices because they don't have the access that we have, and they don't have the strategy that we have, and they don't have that same appeal to the songwriting community. So, we believe that songs are a great asset class. It's something that people consume every day. It's a part of our lives. And we've created a company that gives the investment community this access to be a part of the earnings that come with these great proven songs. And I just want to take the time to thank you for listening. And certainly if you have questions for me, please go via your think tank hosts, and they'll get them to me, and I'll be happy to answer them on a direct basis. Thank you, and I hope that the rest of the think tank conference is terrific.